And now there is more of a correlation on the 30-year interest rate to the 10-year Treasury. Why? Because generally people hold on to their mortgages for 10 years. And so as an investor, you can be saying to yourself, hey, I can buy a 10-year Treasury, which is safe and backed by the American government, or I can take a little more risk and buy one of these mortgage-backed securities, which is what we talked about earlier in the podcast, a bunch of packaged up mortgages. What's safer? A bunch of packaged up mortgages based on houses, even if they're great borrowers, like people who invest with us, or the American government. I'm not the greatest fan of the government, but at the end of the day, the government can collect taxes. So probably a 10-year Treasury is going to be a little safer bet. If I could buy a 10-year Treasury or a mortgage-backed security for the same yield, I'm going to go with the 10-year Treasury. And as an investor, if I buy that 10-year Treasury, I'm going to depart with my capital for 10 years. If I buy that mortgage-backed security, I'm going to depart with that capital for 10 years. So I got to put like investment with like investment based on time. And so that's why a 3-year Treasury and a mortgage-backed security doesn't necessarily correlate. Back to the investor's mindset. Okay, cool. The 10-year Treasury is a little bit safer than mortgage-backed security. So what is going to have to happen for me to buy the mortgage-backed security? I'm going to have to get a better return. I'm probably going to need a 5 or 5.5% return. So there's always going to be a spread between the 10-year Treasury and the 30-year mortgage.